Hello, Smarties. Welcome back to Smart Real Estate. I'm Addy Saeed, licensed broker, acquisition operator, and your co-host this week. Joining me is Ribhu Rampersad, mortgage agent, CMHC specialist, and the guy who actually knows how the financing gets done on these deals.
Thanks, Addy. Good to be here. The big week for data. We've got CMHC starts, CIBC provincial forecasts, new federal housing research, and a bunch of capital market signals all landing in the same week. So we have lots to unpack.
Well, we got 9 articles this week, 3 deep dives, and 6 news reaction segments. We're going to be moving fast, but we're not going to cut corners on the analysis. Let's get into it. So 3 themes are running through everything this week. Number 1, Ontario's supply picture is shifting, but the composition matters more than the headlines. Number 2, the macro headwinds are real and the data is confirming it. And number 3, capital is being redirected away from the US, away from condos, and looking for somewhere credible to land. We're going to connect all of that today. Before we get into the data, everything we do here on LIM is free, no paywalls, no gating. Head to learninvestmanage.com, sign up, and you'll get access to all of our tools, plus an invite to our school investor community. Free, learninvestmanage.com. Now, let's go. Let's open with CMHC April stats data. This is primarily a federal statistics release, tier 1 sourcing, no caveats. Ontario posted 6,680 total housing in April. That's up 25% year over year, best single month in over a year.
That headline looks very strong. Do you really have to pull it apart to understand what it's actually saying?
Exactly, because single-detached starts, the stuff that individual buyers are buying, are down 18% year over year. The entire growth is in multifamily, apartments, purpose-built rental, institutional product. That category is up 32.8% province-wide.
So on the financing side, what does that look like? Because purpose-built rental and condo starts are completely different animals from a mortgage and capital structure perspective.
Night and day, purpose-built rental is largely institutional or high net worth equity with CMHC insured debt stacks. That's actually your lane, Ribhu. MLI Select and the whole program.
Right. MLI Select has been a significant driver here. The program provides favorable insurance sales for purpose-built rental, longer amortizations, better loan-to-value ratios. And when developers can access that financing, some projects that were borderline, they actually start to pencil. And I think you're seeing some of that in April numbers.
So let's run through the CMA level data because some of these numbers are striking. Toronto CMA, 3,080 starts in April, up 34% year over year. Multi-units alone were up 44%, single detached down 44%.
Composition in Toronto is almost entirely multi-unit, which makes sense. Land costs in the GTA make single-detached economics almost impossible to justify at current pricing.
KWC is the number that really jumped off the page for me. Kitchener-Waterloo-Cambridge posted 855 starts in April. That's up 235% year over year. Multi-unit alone, 825 units. That's up 260%.
So that's one of those numbers where you have to ask, is this a trend or is it a few large projects landing in the same month?
Almost certainly the latter. A 260% spike in a single month is project concentration, not broad market acceleration. But zoom out. KWC is up 92% year to date. That's not noise. Tech corridor, university anchors, relative GTA affordability. When purpose-built rental pencils somewhere in Ontario right now, KWC is consistently on that list.
And the financing environment supports it. Rental in that corridor has been holding up better than GTA condos. So the rent to cost ratios are a lot more workable.
Hamilton is the counterpoint. 27 starts in April, down 86% year over year, from 193 down to 27.
Hamilton's starts date is notoriously lumpy though. It moves in big project-specific swings. February 2026 was annualized at over 6,000 units and March was just under 300. 1 month of Hamilton data doesn't tell you very much.
I agree. The directional signal from Hamilton is still positive for investors. Rents have held, supply is lumpy, not absent, and the market has been on one of the stronger performers in Ontario. But you can't trade off a single month.
So Addy, what's the overall Ontario seasonal adjusted annual rate or SAAR telling us?
Ontario SAAR, seasonally adjusted annual rate for April 2026 was 81,823. That's up sharply from 51,556 in March, but March was a weak month. Year over year on SAAR, Ontario is up from 65,839 in April 2025. So the trend is positive. The question is whether it's sustainable or whether we're drawing down the pipeline that isn't being refilled. So there are key takeaways. Ontario April stats, 6,680 units, up 25% year over year, but 100% of that growth is in multifamily. Single detached homes are down 18% year over year. Individual buyer market remains suppressed. Toronto CMA, 3,080 starts, up 34%, multi-unit driving everything. And Kitchener-Waterloo-Cambridge, 855 starts, up 235%. Project concentration spike, but 92% year-to-date gain is a real trend signal. Hamilton, 27 starts, down 86%. It's volatile and lumpy data. Do not read it as a trend reversal. Purpose-built rental and MLS select financing are the structural drivers for multi-unit growth. GTA condo launches remain near zero. Today's start are drawing down an existing pipeline. So something worth watching and something that you should be asking. When does the purpose-built rental pipeline run thin? Projects breaking ground today were approved and financed 18 to 36 months ago. What's in the current approval queue matters more than what's starting right now. And CMHC methodology review on unabsorbed Ontario inventory data is ongoing. Treat any Ontario absorption stats with caution until it is resolved. CIBC Capital Markets published their provincial economic forecast this week. Catherine Judge is the author. This is a tier 1 institutional research, the kind that institutional capital actually trades on. And for Ontario, the numbers are very, very sobering.
What's the headline?
Well, Ontario, 1% real GDP growth forecast for 2026. Weakest of any major province. Quebec is at 1.2%, BC is 1.1%, Ontario is at the bottom.
What's driving that underperformance, though, relative to the rest of the country?
Three things. First, Ontario's heavy exposure to U.S. trade. Quebec and Ontario were amongst the hardest hit by tariff uncertainty in 2025, according to CIBC. Second, population decline. Ontario population fell 0.7% year over year in Q1 2026. Non-permanent residents still make up 6% of Ontario's population, above the 4% national average. And CIBC flags further declines ahead as work and study permits expire.
So that population number is significant. We've been operating in an environment where population growth was a backstop for rental demand. So if that backstop is eroding, the near-term rental market softens even further.
That's exactly the read. And CIBC explicitly flags that restriction on non-permanent residents will continue to be a drag on growth in the second half of 2026, particularly in Ontario and BC. Third driver, consumption headwinds. Discretionary spending is already under pressure from 5-year mortgage renewals hitting at higher rates. Housing price weakness is restraining home equity spending, and slower home sales are hitting furniture, appliance, and renovation spending.
From a mortgage perspective, I want to add some texture here. The renewal cliff is real and it's not done. People who locked in at pandemic-era rates in 2020 and 2021, they're renewing now or in the next 12 months. Payment shock varies, but for some borrowers it's significant, and that money is coming out of discretionary spending.
Yeah, the 2027 picture is more constructive. CIBC is forecasting Ontario real GDP at 2.1% in 2027. That's a significant step up. And on housing specifically, they're forecasting a sharp rise in per capita housing starts in Ontario in 2027 after years of decline.
What are the conditions for that recovery?
Yeah, two conditions. One, trade clarity, obviously. CIBC base case assumes Canada retains tariff-free access to CUSMA-compliant goods, either through a formal agreement or a review process getting pushed into 2027. And number two, end to the Middle East conflict. CIBC explicitly ties the global macro recovery to that resolution. These are real conditions with real uncertainty attached.
What you're saying is the 2027 recovery thesis is conditional, and it's not guaranteed.
Correct. And it's not me saying it is CIBC. We're just a mouthpiece for them. The unemployment data confirms the slack. Ontario's unemployment is at 7.7% in 2027. Forecast to hold at 7.6% in 2026 before improving to 6.8% in 2027. CIBC actually notes Ontario has the most labor market slack in any province alongside Newfoundland. That's not a strength. But it does mean there's room to absorb growth without triggering inflation when the recovery comes. So a couple of takeaways. Ontario 2026 fiscal real GDP 1%, bottom of the major provinces driven by trade exposure, population decline, and consumption squeeze. Ontario population is down 0.7% year over year in Q1 2026. NPR at 6%, or non-permanent residents at 6% of population. Further declines expected. 5-year mortgage renewals at higher rates are compressing discretionary spending. Near-term rental demand headwind. And 2027 recovery thesis is 2.1% GDP, sharp rebound in per capita starts, but conditional on trade clarity and Middle East resolution. Ontario has most labor market slack in any major province, room to absorb growth in recovery phase. Something worth watching. Non-permanent residents population needs to be tracked, specifically work and study permits expiry timelines. The rental demand signal is directly tied to how fast the population declines through late 2026. And CUSMA review timing is another thing to watch. If trade talks drag into 2027, CIBC's recovery scenario gets pushed and Ontario housing start rebounds also gets delayed. Quick break. If you're finding value in this analysis, share it with one investor in your network. Everything we do is free at learninvestmanage.com. Sign up and you'll get access to all LIM tools plus our school community, learninvestmanage.com. This one is more academic than our typical market data, but its implications are significant. CMHC's chief economist, Matthew Labarge, published new modeling this week showing that if Canada's housing supply had been as responsive as the American industry between 2006 and 2024, we could have seen roughly 30% more housing starts and prices about 10% lower in that period.
Those are some striking numbers. What's the methodology?
CMHC's integrated housing model. They drew on OECD research on supply elasticity. Important caveat up front. These are hypothetical model scenarios. What could have happened, not forecasted what will happen. We're not going to throw these numbers around as if they're observed data.
Understood. So what is the model actually saying?
The diagnosis is structural. Three things make the American industry more agile than Canada. First, geography. Most major Canadian cities face geographical constraints to development. Vancouver has the water and mountains. Montreal is on an island. These constraints slow supply response when demand moves. Prairie cities like Edmonton, open landscape, higher per capita starts, that part we can't control.
What about the second factor?
Second is demographic concentration. Canada has too few densified urban cities. In the US, if you can't afford New York, you can move to Chicago, Philadelphia, Dallas, or Charlotte, or find comparable work. In Canada, if you can't afford Toronto, Montreal and Calgary are your realistic alternatives. Vancouver is already unaffordable. That concentration makes household captive to a small number of markets and slows the market response. Third is regulation, land use and zoning rules. This is one factor CIBC says is fully within our control. CMHC research confirms that more restrictive land use increases prices and reduces annual starts. The market with the lowest rezoning approval rates have the weakest supply responses, and those tend to be the most expensive and highest demand markets.
So what are we actually doing about it? On the financing and policy side, I'm seeing some of this in practice. The Housing Accelerator Fund has been meaningful for some municipalities, reducing approval timelines and cutting red tape.
Yeah, CMHC flags that explicitly. The Housing Accelerator Fund, the Build Canada Strong agenda, development charges cut, these are all early stage reform signals. But here's the key line from LaBerge. The benefits are not instantaneous. They take time to enable and materialize.
Which is consistent with what I'm seeing on the ground. A developer cutting a deal today because development charges are lower, that doesn't show up in starts for 18 to 36 months. Policy does work, but it's on a lag.
And that lag is actually the investor thesis. If you believe the reform compounds over time, and the evidence from CMHC's own modeling suggests that it would, then the supply environment 3 to 5 years from now looks very different than today. You're not investing in the current environment, you're positioning for the one that is building right now.
Risk is that the reforms stall. Political will changes. A new government rolls back zoning changes, and we've seen that cycle before in Ontario.
That's the real bear case in the story. Not that the analysis is wrong, it's that the implementation is hard and political timelines don't always match with development timelines. So, key takeaways. CMHC model, matching US supply responsiveness over 2006 to 2024 could have produced 30% more starts and 10% lower prices. Hypothetical scenario, not a forecast. There's three structural constraints: geographical limits on Canadian cities, demographic concentration in a few urban areas, and restrictive land use regulation. Regulation is the only one that is fully within our control, and it's a controllable lever, and current reforms are in early stages. Reform benefits operate on an 18 to 36 month lag minimum. Policy today shows up in starts in 2 to 3 years from now. And the bear case is that political will for sustained regulatory reform is historically inconsistent in Ontario. Some of the things worth watching. So rezoning approval rates in Toronto, Hamilton, and KWC, these are the leading indicators on whether regulatory reform is actually landing at the municipal level. And number two, Housing Accelerator Fund deployment. Which municipalities have accessed it and which approvals have accelerated these results? All right, so we got 6 more stories this week. We're going to move through these efficiently. Ribhu, I'll set each one of them up for you to add the financing and legal angle where it's relevant.
Let's go.
All right, number 4, Carney confirmed that Ontario development charges cut this week. Speaking in Vancouver to the Greater Vancouver Board of Trade, development charges cut up to 50% for 3 years. Federal and Ontario governments each committing $4.4 billion, so $8.8 billion in total, to backstop the municipality's revenue loss. Carney estimates up to $200,000 lower project costs per unit in some cases.
So that's material for project feasibility. On deals I'm seeing, development charges have been one of the major pain points, particularly in 905 municipalities where they've been climbing deeply. A 50% reduction changes the pro forma in a meaningful way for purpose-built rental.
The BC angle in the article is outside our lane, but what is relevant is Carney flagging BC discussion are in early stages using Ontario as a template. That confirms that this is a policy framework that has legs nationally. The demand caveat, Carney himself acknowledged demand is currently soft due to immigration target cuts. A policy incentive doesn't build anything if the renter demand isn't there on the other end.
Timing matters. The window of lower development charges is 3 years. Developers who move now capture it. Developers who wait may not.
All right, number 5, we have Canadian capital pulling back from US. So Canada to US commercial real estate volume fell 32% year over year, down to $5 billion for 12 months ending March 2026. That's less than half the 5-year average. Canadian investors allocated 37% of outbound capital to U.S. assets, down from 54% the year prior. Tariffs, political friction, and the cultural pivot are reshaping where Canadian money goes.
So the Sovereign Wealth Fund launch is a policy signal that gives us legs. CONI is explicitly building institutional infrastructure for domestic deployment.
The investor angle for us, if institutional capital is coming home and looking for domestic alternatives, Ontario multifamily is liquid, transparent, and domestically understood. We want to be clear, this is a directional signal, not a confirmed flow. But signals like this tend to move cap rates before the data catches up. Next, we have office to residential conversions. Has the wave run its course? So this is from RENX. Avison Young's National Market Intelligence Director put some data behind the office conversion story. More than 10 million square feet of Canadian office has been converted, demolished, or is in the pipeline. If all planned projects proceed, roughly 17,000 new residential units nationally will be made available. Real number, not a crisis solution.
Toronto-specific model is the one that matters for our audience.
Right. Toronto doesn't convert, it demolishes. Land is way too expensive to preserve an existing structure where you can build maximum density residential from scratch. Class B office vacancy nationally is still double digits. That inventory isn't recovering for office use. It's transitioning. Institutional capital has returned to the office sector, but it's buying quality trophy assets, not conversion plays. The panic era is over. What comes next is obsolescence driven, building by building, wherever the economics allow. All right, story number 7. Durham Region approved a 25-year plan to add 72,000 residents to Northeast Pickering. 16,000 acres. It was a 5-2 council vote. This is a long-range demand signal for the Durham corridor, one of the last large-scale greenfield areas left in GTA. When a secondary plan gets approved, land values in the surrounding area get repriced long before the shovels hit it.
What's the bear case?
Well, there's 3 real risks. 1, Seton, the last major Pickering greenfield project, is still 60 to 70% unbuilt. Why add a new development area before the existing one gets absorbed? Number 2, no physical impact study has been completed before the vote. The delegates from Stop Sprawl Durham flagged that directly. 3, the Mississaugas of Scugog Island First Nation has not signed an MOU and has consistently expressed opposition. That's a legal and political risk that doesn't resolve quietly. This is a 25-year plan. Don't price it like it's happening tomorrow. Story number 8 is about construction contractor stress. CYMI Canada, the electrical contractor on the Gordie Howe International Bridge, filed a notice of intention to make a proposal on May 12. $24.4 million in contractor claims, contract cancelled for convenience, disputed payments, holdback that never got released, and arbitration underway.
So this isn't a multifamily story on the surface, but the holdback piece is something every developer and investor in this room should understand.
Exactly. Holdbacks are a standard part of construction contracts in Ontario. Typically 10% of progress draws held back until substantial completion. When those holdbacks get disputed or withheld in a project termination scenario, it can push a contractor that was operating fine on paper into a liquidity crisis. That's what's happened here. The construction ecosystem that builds your rental project runs on the same thin margins and extended billing cycles. When contractors at this scale hit a wall, it signals fragility in the broader build environment, and that translates to delivery risk on your projects. And story number 9. This is a legal story, but the implications for anyone who has put equity into real estate syndications are direct. The Alberta Court of Appeal confirmed this week that equity investors, not just secured creditors, not just the insolvent company, can trigger CCAA restructuring proceeding. This is very new. There is no prior Canadian precedence for this.
What was the specific fact pattern?
So a group of Canadian equity investors in a real estate project, the Angus Manor Lands in Ontario, used CCAA to stop an imminent asset sale and force court supervision of the process. The appellants challenged their standings. The Court of Appeal upheld it. The threshold: equity investors must show a reasonable possibility the value remains after non-equity claims are addressed. In this case, no known secured creditors, insubstantial other creditor claims. The equity investors were found to be the fulcrum stakeholders.
What does that mean practically for someone who's invested in a syndication?
It means that you may have more legal tools available to you than you previously thought if a project goes into distress. Before this decision, equity investor ranked last and largely had no lever to pull on when a project started unwinding. Now, in the right circumstances, you can trigger court supervision rather than watching a developer or secured lender force an asset sale at a price that wipes you out completely. Know your rights before you need them. So let's close by connecting the thread. 3 things are running through everything we covered today. Theme 1, supply is moving, but the composition is everything. Multi-unit is up across Ontario, but it's purpose-built rental drawing down an existing pipeline, not a new condo cycle starting. AWC is the market to watch. Toronto is executing but not replenishing. Hamilton is volatile and not absent.
Theme 2, the macro headwinds are real and confirmed. CIBC has Ontario at the bottom of the provincial growth table for 2026. Population is declining and renewals are squeezing tumors. 2027 recovery thesis has merit, but it's conditional. Trade clarity and geopolitical resolution are the prerequisites.
Theme number 3, capital is repositioning away from the US, away from condos. Development charges are coming down. The regulatory reform signal is early, but it's there. Institutional capital is looking for a domestic home. That's the medium-term setup for Ontario multifamily. And the smarties in this audience are positioned ahead of when that capital arrives. So we got key takeaways. Ontario April starts 6680 units, up 25% year over year, entirely multi-unit driven. Single detached down 18%. KWC is the breakdown market. 855 April starts, up 235% year over year, up 92% year to date. Ontario 2026 physical GDP is 1%, worst of major provinces. 2027 recovery is conditional on trade and geopolitics. CMHC modeling, supply reform compounds over time, but benefits take 18 to 36 months minimum to materialize. Ontario development charges cut 50% for 3 years, $8.8 billion in federal provincial backstop, up to $200K per unit saving. Canadian institutional capital is redirecting away from the US real estate. Ontario multifamily is a credible domestic alternative. Equity investors can now trigger CCAA proceedings. Alberta Court of Appeal confirms standing. Know your rights. Before we sign off, there is a new update that has just come through, and Ribhu was kind enough to share it with us. CMHC has just updated the benchmarks. What you see on the screen were the existing benchmarks when you're underwriting any apartment building in Canada. Ribhu, do you want to walk us through what the different changes are that were coming through?
Yes. So on June 1st, CMHC released a new set of operating benchmarks for us to use when underwriting any CMHC insured multifamily deals. So MLI Select, CMHC Standard, etc. These changes take effect for any application that is submitted on or after June 8th, 2026. Ultimately, what that means, higher expenses equals lower underwritten NOI, which equals tighter debt service coverage. The key pieces that it affects is the management fee has increased pretty much across the board from 4.25% to 4.5%. And benchmarks for maintenance and repair reserve funds, as well as salaries expenses have gone up in differing amounts based on type of construction and province. Prairies and BC, other costs category has also had some reductions to partially offset the M&R and salary increases. But in Quebec, they've actually added a new other cost line items previously buried in Quebec in a M&R line item. So bottom line, any application submitted on or after June 8th will be underwritten to higher benchmark expenses across the board. It's important that if you have a file on the go, reach out with your broker or lender to get that submitted ASAP. Or if you have one in the pipeline, you'll have a chat with your lender or broker to understand how this is going to impact your project financing.
So this is very interesting. So if you have a wood frame building, it used to be $830 per unit per year or annually. Now it's bumped up to $940. For concrete, it used to be $975 and now it is $1,090. Salaries for concrete used to be $700, now it's $770. For wood frame was $555 and now we're looking at $610. Those are substantial changes that have come through. So what sort of valuation difference do you expect that we're going to see? Obviously, can you quantify it in terms of a percentage?
Yeah, so across the board, it's about a 10% increase in operational expenditures. So roughly what this results in is about 5% increase in percent of effective gross income. So it's a ratio we look at when we underwrite a building, operating expenses divided by effective gross income, and there's a 5% impact on that. So for example, this morning we underwrote a file. It's a $2 million 10-unit purchase at a 4.75% cap rate. We're maxing out the DCR of 1.1 on that. The impact of this changes now requires an additional $35,000 down payment on top of the 15% that was already required. On a $2 million purchase, that's pretty substantial.
So for anybody that has any application that is pending or you're thinking about making any moves, connect with your broker right away, have a conversation and get your application in so you can take advantage of what was there before you miss out on it. So that's a wrap on Smart Real Estate for the week of June 2nd. If you're a smarty, you know where to find us. LearnInvestManage.com, free sign up, free tools, free access to our school investor community, no paywall, no gating, just institutional quality analysis for people who are serious about Ontario multifamily. We will see you next week. Addy Saeed is a licensed real estate broker with Remax Gold Realty, RICO license 4735346, founder and general manager of Westcliff Living, and an OSC registered dealing rep. Ribhu Rampersad is a licensed mortgage agent, level 2 with BLD Financial, DLC license 12360. The host may reference companies and entities in which they hold ownership and or financial interest, including Westcliff Asset Management, Westcliff Living, Olympus Properties Group, and Finalize LLP. Listeners should be aware of these relationships when evaluating the commentary in this episode. The podcast is for informational and educational purposes, Nothing in this episode constitutes legal, financial, mortgage, or investment advice. Always conduct your own due diligence and consult qualified professionals before making any investment decisions. Past performance is not indicative of future results.